As whispers of potential from ZoomInfo Technologies, ticker symbol ZI, filled the air, 4 analysts managed to botch history with their predictions. Welcome back to Incompetent Capital. Today, we're diving into the baffling saga of ZI stock, a company that recently turned the market upside down. While investors were hoping to ride the wave of success, 4 analysts decided to jump in with their predictions. And boy, did they manage to belly flop. Seriously, it's almost impressive how spectacularly they missed the mark. You have to wonder if they were looking at a different company altogether, or just throwing darts blindfolded. As the dust settles, the question remains: how did these so-called experts manage to turn a promising opportunity into a comedy of errors? With a combination of wishful thinking and a complete disregard for market realities, their calls left many investors scratching their heads in disbelief. It's hard not to feel a little disgusted when the people we trust to guide our financial decisions fumble so spectacularly. But don't worry, this isn't just a tale of woe. Today, we'll peel back the layers on ZI, uncovering the real story behind its performance while sharing some critical lessons along the way. There's always something to learn from a disaster, especially when it involves seasoned analysts dropping the ball. Join us as we explore the truth behind ZI stock and equip you with the insights you need to avoid the pitfalls these analysts stumbled into. Your investment journey just got a lot more interesting. But before we dive deeper into the twists and turns of ZI stock, let's take a moment to address a common headache for many aspiring investors and content creators: navigating the overwhelming world of online visibility. It's frustrating to pour your heart and soul into your content, only to see it get lost in the digital abyss. You're not alone in feeling like you're shouting into the void. Thankfully, there's a solution that can turn that struggle into success. Imagine harnessing the power of cutting-edge AI to skyrocket your YouTube channel's growth and engagement. Matt Parr's Tube Magic course is designed to help you leverage AI effectively, giving you the tools you need to create content that truly resonates. With this course, you'll learn how to craft compelling videos that attract viewers, optimize your content for search, and build a loyal audience. The benefits are clear: elevate your content strategy, save time on tedious tasks, and position yourself ahead of the competition. Plus, you'll gain access to insights on the latest AI tools that can revolutionize your workflow. Some of the coolest features include step-by-step tutorials, insider tips from successful creators, and real-time feedback on your content strategies. So, if you're ready to stop floundering and start thriving, click the link in the description to join Matt Parr's Tube Magic course today. Trust me, those who master AI will be the envy of those still stuck in the past. Now's the time to take your channel to the next level. Now that we've set the stage, let's delve into the heart of the matter: the analysts who so spectacularly missed the mark with ZI stock. What financial blunders did they overlook? What hidden signals did they completely ignore, leading to a cascade of wrong predictions? The suspense is palpable, and trust me, you won't want to miss our deep dive into their incompetence. Leading the charge in our incompetence court is none other than Michael Turin of Wells Fargo. The first defendant in our lineup of blunders stands charged with gross incompetence. With the vast resources of one of the biggest banks at his disposal, you'd think he would have had a clear view of the landscape. Yet, he managed to botch history with his misguided calls on this stock, leaving many investors reeling. Michael began his coverage of ZoomInfo Technologies back in June of 2020, right as the IPO rolled out with an equal-weight call with a price target of 55, when the stock was hovering in the low 50s. He then began a game of chase and wait, as his next few calls essentially chased the stock price and remained neutral. But soon after that, in September of 2021, he couldn't hold back any longer. He quickly segued into an overweight call as he grabbed the old pom-poms out of the closet and began a game of chase and cheer that would last indefinitely, at least so far from today's chart. Unfortunately, indefinitely not only included a major bull run, but also included a major crash from its all-time high of 79.17 to where it currently sits at about $9 and change. To add insult to injury, right after the peak, Michael decided to consistently overbid the stock and has never even matched the price it trades at. Absolutely egregious, guilty as charged. Siti Panigrahi of Mizuho stands charged with first-degree financial bank slaughter. Siti also joined in on the IPO and didn't hesitate to jump in on the chase and cheer bash. Except unlike his friend Michael, He wasn't shy in the beginning. He jumped in face first with overbid buy calls, which essentially lasted until the trenches, where unlike Michael, again, he decided to segue into neutral. Great, so lure in unsuspecting investors during an IPO, only to tout it as it climbs and then takes a nosedive, and then turn around in the trenches and say you don't know what is going on? What the hell is this guy thinking? But this yet again demonstrates our point that neutral calls from analysts, especially ones in the trenches like this one, should be more read, like sell calls, as these analysts often operate with unofficial pressure to not make outright negative calls, as that can tarnish business relationships with the firms that they often represent, which also often happen to be the firms that they are supposed to be making accurate judgments upon. What we're saying is that while he did turn around in the trenches and say, "I don't know what is going on," we can safely infer that he knows damn well what is going on, but is not allowed by his owners, I mean his bosses, to say it. Guilty and sentenced to a life of having to make actual trades with his money based off of his own official calls. Brent Bracelin of Piper Sandler is also being charged with first-degree financial bankslaughter and with copying Siti Panigrahi's homework. Brent also began coverage of ZoomInfo Technologies as the IPO rolled out. The cheer squad was short on members because Michael was being a sourpuss with his initial neutral calls, so Citi began to peer pressure Brent, and Brent eventually gave in and said, "Okay, but so long as you let me copy your homework." So Brent essentially added a few here and subtracted a few there from Citi's calls, and history was grossly botched by both of them, as you can see on the chart. Brent even copied the neutral swap in the trenches move. Guilty as charged. The chart doesn't lie. David Hines of Canaccord is being charged with gross incompetence. David began his coverage of ZI in September 2020 after the IPO hit the market. He said no to the cheer squad and joined Michael Sarpus' squad initially, but couldn't resist the urge to cheer for long. So he joined the cheer squad, albeit with an air of Sarpus. As you can see, his overbids were definitely less aggressive than the rest of the squad. But to make up for it, he held on to his ridiculously incorrect buy thesis to the bitter end. Not even a sign of buy-neutral segue hinted by this one. Guilty as charged. Now you notice how more or less all these guys are doing the same thing. Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. This exposes something we mention a lot on this channel about how analysts on Wall Street essentially copy each other to avoid making calls that fall out of the norm. This analyst groupthink happens across the board regularly. Instead of making calls that are based on sound analysis that would fall outside of the incompetent norm, these analysts tend to aggregate towards the comfort zone. They all more or less match each other, because if everyone is an idiot, then no one will likely get fired for idiocy. If, however, they do run a sound analysis and scream the truth and then happen to be wrong, then they may get held accountable when they could have just as easily clocked out early, copied everyone else, and continue to drink and snort bad things instead of going to work. Now that we've seen how these analysts fumbled spectacularly in incompetence court, it's time to shift gears and dive deeper into the story behind ZoomInfo Technologies itself. Beyond the misguided predictions and baffling missteps of Wall Street's finest, ZI's journey is filled with key moments that shaped its volatile rise and dramatic fall. To truly understand how these experts got it so wrong, we need to explore the company's history, its growth strategy, and the factors that sent its stock soaring before it came crashing down. Buckle up as we peel back the layers and uncover the real story behind ZoomInfo's meteoric yet shaky trajectory. ZoomInfo Technologies, founded in 2007, initially started as a data-driven platform designed to help businesses identify and connect with decision-makers. Its rapid rise was fueled by its unique approach to sales intelligence, using advanced algorithms to gather and organize business information in real time. The company quickly gained traction as more businesses sought data-driven insights to fuel their sales pipelines. After going public in 2020, ZoomInfo was positioned as a dominant player in the B2B information services space, with promises of continued growth, expanded offerings, and aggressive acquisitions to broaden its market footprint. Investors flocked to the stock, enticed by its promise of being a leader in business intelligence for the digital age. However, beneath the surface, cracks in ZoomInfo's growth story began to emerge. While the company's initial public offering, IPO, was met with enthusiasm, the stock's performance became increasingly volatile as macroeconomic factors, competitive pressures, and internal operational challenges took their toll. The high expectations set by analysts and the company itself became a double-edged sword. As the market became more saturated and data privacy regulations tightened, ZoomInfo struggled to maintain the rapid pace of growth that had fueled its early success. Investors began to realize that the company's reliance on aggressive acquisitions was unsustainable, and questions arose about its ability to generate organic growth in an increasingly competitive landscape. ZoomInfo's fall was deeply intertwined with both regulatory challenges and a shaky financial foundation. On the regulatory side, data privacy laws like GDPR, General Data Protection Regulation, and CCPA, California Consumer Privacy Act, struck at the core of its business model. These laws imposed stringent limitations on how companies collect, process, and share personal data, forcing ZoomInfo to overhaul its data gathering practices. For example, under GDPR, businesses must obtain explicit consent from individuals before collecting their data, severely impacting ZoomInfo's ability to build and maintain its massive business intelligence databases. Non-compliance could result in fines up to 4% of global annual turnover, creating a major compliance burden. Similarly, CCPA required ZoomInfo to provide California residents the right to access and delete their personal information from its databases, further complicating its operations. As more U.S. states and countries adopted similar regulations, ZoomInfo faced increased legal and operational costs to comply with a patchwork of data privacy rules, which cut into their profitability. The company's significant downturn can be attributed to several interconnected factors. One major contributor has been the company's consistent weak earnings guidance, which often projected lower than expected revenue, adjusted operating income, and free cash flow. This kind of guidance typically raises red flags for investors, as it suggests underlying weaknesses in the business. Compounding this issue is a decline in customer numbers. The company reported that its small business customers faced more challenges than anticipated in the first quarter, indicating a struggle to maintain a robust client base. Additionally, the company is currently embroiled in an investor lawsuit, which alleges that ZoomInfo employed coercive tactics to retain customers. Such allegations have not only tarnished the company's reputation, but also resulted in declining customer satisfaction, which directly impacts revenue. Further complicating matters, the lawsuit claims that ZoomInfo's financial results were artificially inflated due to the favorable conditions created by the COVID-19 pandemic. As the pandemic's effects waned, investors began to question the sustainability of the company's previous growth, contributing to a loss of confidence that ultimately led to a sell-off of ZI stock. These factors combined paint a troubling picture for ZoomInfo, prompting investors to reassess the company's long-term viability in a challenging market. In today's fast-paced financial landscape, investors must prioritize due diligence to navigate the complexities of the market effectively and avoid being caught off guard by unforeseen developments, such as regulatory changes or corporate misconduct. Staying informed about the latest regulations is crucial, as these can significantly impact a company's operations and stock performance. To do this, investors should regularly follow reputable financial news outlets, subscribe to industry newsletters, and engage with professional investment forums. Keeping an eye on regulatory announcements and proposed legislation can provide early insights into potential risks that could affect their positions. Moreover, conducting thorough research on a company's management team, governance practices, and historical performance is essential. Investors should delve into executive backgrounds and their track records in handling past challenges. Understanding a company's business model, financial health, and customer satisfaction levels can help paint a clearer picture of its sustainability and growth potential. Additionally, reading financial statements, earnings reports, and conference call transcripts can offer valuable insights into a company's operations and any emerging issues that may not be immediately apparent. Being proactive about these measures is vital. Investors should start their research well before making investment decisions, giving themselves ample time to assess the potential risks and rewards. Setting up alerts for significant developments related to the companies they are interested in can help ensure they remain updated on crucial changes. Furthermore, diversifying their portfolios can provide a buffer against the fallout from any single company's missteps. By taking these steps, investors can better position themselves to avoid pitfalls and make informed decisions, safeguarding their investments from unexpected downturns. Being proactive is a must, otherwise we risk falling prey to all the parasites working on Wall Street. So stay in the driver's seat and do so with competence. For if you don't, you just may wake up one day, turn on YouTube, and find yourself sitting in the incompetence court. So in short, the saga of ZI stock is not just a story of analysts' incompetence. It's a reflection of the broader challenges faced by investors in today's fast-paced market. By learning from these missteps and remaining vigilant in our analysis, we can better navigate the complexities of investing and make informed decisions that align with our financial goals. As we continue to explore the intricacies of the investment landscape, remember, the best insights often come from within, not from the so-called experts. Join us next time on Incompetent Capital, where we'll dissect more financial blunders and equip you with the knowledge to succeed.